You're listening to Simply Put, a podcast from FHN Financial. I'm your host, Will Compernell. The economy looks poised to endure this year's federal policy shocks without a recession or a major flare-up in inflation. Investment into artificial intelligence has supported economic growth without adding many jobs, making it unclear how AI will impact the full employment side of the Fed's dual mandate. Meanwhile, the lack of consensus within the FOMC will face further pressure next year with a new Fed chair. Today's episode is a live recording of the Economics Roundtable from FHN Financial's annual seminar in Nashville. I'm joined by Chief Economist Chris Low, Senior Economist Sophia Kearney-Lederman, and Economic Analyst Mark Streiber to discuss how economic resilience and ongoing Fed policy normalization could change from lingering tariff impacts, the structural shocks from artificial intelligence, and the new composition of the FOMC next year. Stay tuned. Coming up soon, FHN Financial's economics team discusses our forecasts and the biggest risks to the outlook. But first, a quick market update. The Fed cut the Fed funds rate 25 basis points this week, as expected. After growing signs of pressure in short-term funding markets, they also announced, starting in December, that they will stop letting Treasury securities on their balance sheet roll off. They will still allow mortgage-backed securities to roll off and will use those proceeds to reinvest in T-bills. During the press conference, Chair Powell insisted a December rate cut was not a foregone conclusion, trimming investor expectations for another 25 basis point cut at the next meeting from 24 basis points in Fed funds futures to about 16 basis points. He also noted, despite the current data abyss caused by the government shutdown, available anecdotal evidence and surveys should be enough for the Fed to recognize any major economic inflection point. Treasuries responded to this week's Fed communication by selling off 5 to 8 basis points after staying in a holding pattern for most of the last 2 weeks. The government shutdown has postponed almost all government data collection, so bond investors have been reluctant to significantly alter their outlooks for the economy or interest rate policy. One exception to that postponement was last Friday's release of the September CPI. The BLS called back enough employees to do the final tabulations of data collected before the shutdown, in part so that the Social Security Administration would have enough time to make its cost of living adjustments for next year's benefits. Both the headline and core CPI rose a tenth less than expected, firming market expectations for a Fed cut this week. The smooth trends otherwise show underlying inflation stubbornly above the Fed's 2% target. The federal government is still shut down, and there are no signs of it reopening anytime soon. The House is out of session, and congressional leaders are showing little urgency in striking a compromise. Along with the data disruptions, the shutdown is starting to have real economic impacts from federal workers missing paychecks, rising absenteeism from TSA employees, and, starting this weekend, SNAP recipients not receiving benefits. Betting markets currently suggest the shutdown will end sometime in the second half of November. Treasury Secretary Scott Bessent announced the White House search for the new Fed chair was down to 5 candidates: Chris Waller, Mickey Bowman, Kevin Warsh, Kevin Hassett, and Rick Ryder. Most analysts expect the president will announce his nominee around the end of the year. That's all for the market update this time. Now our live recording with FHN Financial Chief Economist Chris Low, Senior Economist Sophia Kearney-Lederman, and Economic Analyst Mark Streiber. Welcome, everyone. Good to see all of you this morning. We are ready for our economic roundtable. And Chris, to start things off, a couple questions for you before I open it up to the rest of the group. You released a forecast about a week and a half ago, 2 weeks ago. So before we go into the kind of substance of the conversation, why don't you summarize for us your outlook for the economy and rates through this year and next year?
I think the most important thing is this relationship between growth and employment and how it's changed. And when you think about the way the Fed views the economy, right, that they run policy to try to target growth. And the reason they're doing that is they're trying to control the labor market, keep it at full employment, but not such a low unemployment rate that there's a shortage of workers, because they then think the most likely cause of inflation is low unemployment, companies competing for workers, wages start to accelerate, and that wage acceleration produces two things, right? It produces costs for the businesses, and they want to raise prices to try to recoup those costs, but it also produces income for the workers, which enables households to pay higher prices, and you get a wage price spiral. The last time that happened in the US was arguably maybe in the 1970s, but it is still the guiding principle of the Fed. The reason I bring all that stuff up is because looking at the forecast, we have pretty strong GDP growth. I talked about this yesterday. The economy's running at 3.9%, or at least that's what the Atlanta Fed is tracking in the third quarter. Economy grew 3.8% in the second quarter. That's strong growth, and yet we have very little job creation. And I think that reflects changes in the economy that are taking place now. It's the emergence of AI and massive data centers, but it's also the dominance of social media in the economy as well, which is one of those odd creations, right, where the users are creating most of the content. So most of what's sold on social media is actually created by us, the users, not by the employees of the companies. So I have this forecast where I've got solid economic growth, and yet the Fed is able to cut rates. They're able to cut rates because of two things. One, the slowdown in employment we've already seen, and two, a slowdown in inflation that should happen next year as the big impacts from the tariffs begin to fade. Those two things allow rates to come down. And then the final point is there's two kinds of rate cuts from a market perspective. There's the ones that traders are okay with, that investors think, okay, this makes sense. And in that case, market interest rates can come down as well. But if the Fed is cutting rates and in the markets we don't think it's justified, well, then the long end will actually go up in yield and the curve will steepen. We've got the curve steepening a little bit, but it's a bull steepener where interest rates along the whole curve are coming down. They're just coming down fastest at the front end.
So one question before we open things up to the group, focusing on inflation. So the last couple years plus, inflation really has moved horizontally, no matter what metric you're looking at, 2.5%, 3%, maybe a little bit higher. And in your forecast, we do get below 2%. So what is that final push that gets inflation to the Fed's target, and when do you think it evolves?
It's already here, and it's evident in the data. If you look at things, for example, look at the year-on-year measure of house prices, right? Which in the CPI and the PCE, it's actually rents that they're measuring, but owner's equivalent rent. On a year-on-year basis, that has been coming down. So when I dissect the data, and actually Will does this too, he writes the Inflation Lab every month, what you see is the tariffs are holding inflation up at the moment. But behind the tariffs, inflation is slowly coming back down. And so once those tariff effects fade, the underlying downward momentum takes charge again, and we ease back towards 2%. I do think the Fed is right. We don't get there maybe even within a year. Maybe it takes a little longer. But who knows? You know, with the labor market cooling down, it could be faster.
So let's talk a little bit more about tariffs. We're 6+ months past the April 2nd tariff press conference, even longer past the initial tariffs announced on Canada and Mexico. And the way that I look at how things stand now, no one fully got tariffs right. I think in October of 2025, no one thought this is where we would be. So the critics, the doomsdayers of tariffs, were wrong in that the economy didn't collapse, inflation didn't spike, and we haven't really seen any massive capital outflows away from treasuries that a lot of people expected. Now, I think the proponents of tariffs, however, were also incorrect. Exporters didn't absorb much of the cost of tariffs outside of Japanese car manufacturers, but broadly speaking, from the US import price indexes, exporters were not the ones to pay that. The trade deficit hasn't narrowed, and there aren't really any signs of a manufacturing boom. So my question to the panel now is, why did really everyone writ large misunderstand the impacts of tariffs, or is it just that we need to wait a little bit longer for the lagged impacts?
I hate to use this term that we're using a lot the last 5 years, but I think in some respect because it was unprecedented. And the way we economists in particular in markets think about things is what we know, right? And Chris sort of mentioned in his growth forecast, there's a lot of different things driving the economy, right? AI is very new and different, and social media and influencers. And I think also with tariffs, it was just to a different scale than we've ever seen, right? And the timing has been different. I think there's a great Fed paper that lays out some of sort of when tariffs are passed along, immediately there's a really big impact, but also when they filter along the whole supply chain, there's a very different time impact, right? It's not one-time price in one moment, but it takes time. And I think that's what we all kind of got wrong. We thought tariffs went into place and everyone would immediately put them on to the same extent in the same time period, but that's not what we've seen. We saw a huge inventory build ahead of tariffs, right? To different extent for different industries and different importers. So people are still working through untariffed inventories. We've also seen different responses from firms to tariffs, right? I spend a lot of time in the Southeast in the bank's footprint, and I hear things from firms saying, we immediately raise prices in anticipation of tariffs, to people saying, we're still trying to not raise prices because we're suffering from weak demand already. And so you have this ununiform picture, and I think that's what we all got wrong. And when I think about it, sort of what you said, Chris, about maybe inflation takes a little bit longer to get back to 2%, that's where I sort of see it as well as the Fed, right? That everyone's reacting to tariffs differently, in part because they are still shifting, and in part because people dealt with them at the onset differently as well.
I think the time factor is key. And in terms of the inflation impact, I think Jay Powell's probably right too, that restrictive Fed policy is one of the things that prevented prices from being passed through fully. Manufacturing, great example. You can't manufacture something without infrastructure, and manufacturing infrastructure in the US has been depleted. So I've heard tons of anecdotal stuff from people about we're trying to manufacture with all American parts, but for example, can't find anyone who makes screws like this. 6 months later, hey, there's this supplier that popped up in the Midwest that now makes these screws. So, but it took time. It took someone finding a location, building a facility, getting the machine tools in place, and then up and running. So I think that's part of it. And then, another part of it is, as you said, the novelty. I heard an economic historian saying, I've always pinned the Great Depression on the Smoot-Hawley tariffs. Well, after watching this tariff go into place, I'm going back and rewriting that chapter in the history book. So that, we don't necessarily understand these things the way we think we do.
I even think, to our credit a little bit, we didn't get it right 100%, but we did talk a lot about how we compared the tariffs now to the tariffs in 2018, and how the Fed reacted in a very similar way then to the way that they are now. So we didn't get it right to the extent, I think, that we had thought, but we were saying that we might see some slower growth, we might get an uptick in inflation, and that growth was really limited to a one-quarter contraction, and inflation didn't spike as much as we thought it did, but also that Fed paper does bring up a very good point about how when you have intermediate goods going into other finished products, you have a longer stretch of inflation that comes out of that.
Something that we have seen from tariffs is really significant revenues that have helped narrow the Treasury deficit. And I wonder if this can continue forever. I think it has kept a lid on long-term yields, because as much as it has narrowed the deficit only slightly, it's still improvement, which we haven't seen in a long time. So how do you guys feel the risk is of that budgetary addition going away. And I think there are a number of ways that it could happen. One is that they're reversed through court rulings. So a lot of these tariffs were implemented using emergency powers, and the Supreme Court is going to review whether lower courts' decisions were correct, that they were implemented unlawfully. Another thing is that when the government gets a new source of revenue, they love to find new reasons for outlays. And part of that is even cushioning the pain for farmers or other industries that have been harmed by the tariffs. I think another thing is if the domestic manufacturers do rise up after some time and suppliers are able to use American suppliers, well, that means that they're not importing, so they're not going to pay the revenues, right? The whole idea of tariffs is to incentivize onshoring and production in the US. So if that happens, the tariff revenue is not going to come in. So what do you guys feel are the chances of that risk and how it might impact long-term rates?
I think maybe the most important thing on that is that the tariffs were sold from the beginning as something that's intended to shrink the trade deficit. And Howard Lutnick at Commerce has talked about this at length. If they work, then the tariff revenue is going to be lower over time. We'll have more domestic manufacturing, but that domestic manufacturing is going to increase the corporate tax base. It's going to increase the individual tax base as well, because there will be people employed in those industries. And so we'll make up some of the lost revenue there. But the White House estimates of tariff revenue are actually declining over time, although not as much as the job growth implies, the manufacturing growth implies, because they're also looking at a bigger economy, right? The economy is growing over time. But the CBO estimate, I think, was a little more conservative in that sense, a little bit less economic change, relying on revenue staying up. But then the other thing the CBO brings into the mix, when they talk about $350 billion a year in tariff revenue for 10 years, and then, so effectively what they're saying is that economic growth offsets the shrinking of imports. But then in addition to that, because you've got $350 billion more revenue, you're issuing less debt. And so issuing less debt over years, by the end of the decade, that saves you another $150 billion or so. And they think it's a $4 trillion impact on the debt over 10 years. And I think that's just beginning to come into 10-year note yields, 30-year note yields. And to me, the most striking thing is that out to maybe 10 years, traders, investors have a certain amount of confidence that, yeah, maybe we can make progress on reducing the debt. But beyond that, we're doubtful. And there, I think, it's the point that you made about Congress, that ultimately it is Congress that has responsibility. They're the ones who are going to have to decide whether to spend it or use the revenue to reduce the debt. And I think the market's faith in Congress from a fiscal standpoint is close to zero. And I'm not surprised by that. I just think in both parties, there are remarkably few people who seem to understand the damage that can be done by running huge deficits over time.
Yeah, the thing I really heard from that, there's a lot of ifs right now, right? There's no shortage of ifs everything plays out correctly. I think a big one is when you think about the offset of sort of slowing tariff revenue being that the economy grows and creates jobs. And then we're looking right now at an economy that's growing at a pretty fast level, all things considered, but we're not seeing that job growth. Largely, I think, right now, in part because of uncertainty and wait and see, but in part because of investments in technology. And so even when I think about manufacturing maybe coming back into the US to some extent, the job creation is likely to be lower because the investment is going to be not just in people, but also in technology that requires less people. So that's when I think about that sort of trade-off that has to go exactly right. There's a lot of uncertainty around, well, we talked about it in terms of how we implemented tariffs. The economy's pretty different right now than it has been for the last 25, 35 years. And then the other thing I'll say is, right, I think the prospect that tariffs get ruled unconstitutional and we have to pay anything back in terms of if we have to pay back, that would be chaos. And I don't think that is likely, but I have learned in the last several years, never say never to anything.
Right. I think on that note about Congress, in the 90s, in the 2000s, when we actually managed to get to a balanced budget, every time there was a budget debate, it seems the Republicans are always fighting for a tax cut of some kind. Democrats are always fighting for a spending increase of some kind. But back then, there was this concept of something called the pay for. And you would see it on the front of the New York Times or the Wall Street Journal. Where's the pay for X? And we don't hear that. When the Trump tax cuts went in 2017, there was no pay for. And it was the lack of pay for that Chuck Schumer cited when they initiated that huge Medicaid expansion after COVID. And the Republicans said, where's your pay for? And he said, well, you didn't have one, so we don't need to have one. I'm not going to argue about rights and wrong. What I would love to see is, okay, from now on, no matter which team you're on, let's hear about the pay for.
I want to follow up on something you mentioned, Sophia, which is how we are getting a lot of investment into technologies that are capital intensive. They're not necessarily coming with a lot of job growth. So far this year, underneath that solid economic growth has been a ton of investment in data centers and software. Chris, you mentioned this in your presentation yesterday, and we've written about it. Now, I want to kind of discuss how the Fed is going to react to this. Of course, the Fed's dual mandate focuses on price stability and maximum employment. And so if this investment is coming with not so much labor demand, the Fed can still ease. So that's kind of the thinking behind it. But I want to push back on the assumption that the Fed is necessarily going to feel comfortable easing. One is that they might think GDP growth is speeding up now and the jobs are going to come later. But also, they might feel like the people that are being displaced by this technology are what economists call structurally unemployed. So think about the entry-level programmer or the paralegal that used to go through 300 pages of a PDF that is now replaced by AI. According to a lot of economic models, that is outside the purview of monetary policy, right? Lower interest rates is not going to give those people the skills that are now demanded by the economy. And I remember the decade or so after the financial crisis, when a lot of people were having difficulty finding jobs, there was often this flippant remark, well, just learn how to code. Ironically, now the coders are out of work, but in a sense, we can say as a society, we do want to support these people, get them into jobs, but their skills are not needed the way that they were 5 years ago. It's healthcare workers that we need, home healthcare workers, or other professions that are going to be in demand in this new economy. So is it possible that the Fed is going to see this rise in unemployment and say, well, this is just the structure of the new economy?
Learn how to coal mine? Maybe that's the answer. I think I'm going to push back a little bit.
Please.
When I was in college, in the Stone Age, we rode dinosaurs to school. But back in those days, I had a lot of friends who were paralegals. I had a lot of friends who were entry level wherever. Nobody takes a job as a paralegal thinking this is what I want to retire doing. These are jobs that you take while you look for what you consider your real job. And I think at the moment, AI is displacing a lot of people who actually have the skills to pick up an equivalent in another industry tomorrow, no problem. In the meantime, if you have a big enough structural economic challenge, whether it's the coal workers who were eliminated when everyone said learn how to code, or the coders now who are being eliminated. In fact, stronger economic growth would absorb those workers. I showed the chart yesterday. Almost all of the job growth in the last year, a vast majority of it was healthcare workers. I think that's an industry that's already creating a ton of jobs. What we need is an economy that grows fast enough to create jobs in other areas as well. And we're not seeing that. The fact that duration of unemployment's rising, the fact that the unemployment rate is rising, I think those at the Fed, and naming some names, Alberto Mosalem jumps out, Jeff Schmidt jumps out, who argue that there's simply not enough labor force growth for us to allow faster employment. They're clearly dead wrong when you look at the totality of the labor data. And those like Mickey Bowman and Chris Waller who are arguing that, no, actually, we really could do with faster GDP, I think that is the answer. And we need it before AI starts to influence even more industries. If you haven't read it, go to federalreserve.gov, find the speech Chris Waller gave about AI, technology, and employment. It's absolutely fantastic. I wouldn't argue it's perfect, but it's a good foundation for how we need to think about a rapid technological advance that my friends who are in private equity call the next industrial revolution. And that's not an exaggeration. It's a profound remaking of the economy. There were people who were terrified about the jobs displaced by the Industrial Revolution in the 1700s. And yet, what happened ultimately was a higher living standard, not just for the wealthy, the capitalists, but for everybody in the economy. And if we play our cards right and grow the economy adequately to create new opportunity, it'll lift the boat for everybody.
The really tough thing about that, though, right, is for the Fed in the moment is, yeah, we can think long term and you trust that there will be more job creation and living standards will increase. But in the right now, and particularly really this year, you're seeing a big bifurcation in the economy, right? You're probably hearing about it a lot, reading about it in the news. The top 10% of earners accounted for nearly 50% of consumer spending growth in the second quarter, right? That's huge, right? That's where you have higher income individuals really fueling the economy, whereas the lower, bottom third, and the middle are feeling kind of stretched from the labor market that's slowing, right? These jobs in sort of entry-level industries may be getting replaced, and by inflation that sure hasn't risen as much as we thought this year because of tariffs, but we do still have 3% growth on the CPI, and we have 5 years of cumulative inflation. You've had some disposable income growth in the last 5 years, but almost all of it has been eaten away by the inflation we've seen in things like housing, which is up almost 40% year over year, auto insurance, which is up 55%, right? Grocery prices, I'm sure many people can relate to this one. Your grocery bill is not what it was in 2019 anymore, right? And it feels like it's always getting more expensive. I think the difficult thing for the Fed, and Waller's speech is great talking about the potential long-term benefits in that thought, but they also exist in this moment, right? And they're setting monetary policy for right now and for what they have to do in this moment. And so it really is, I think, a very tough...
Well, but what are they doing in this moment, right?
They're trying to support.
Look at the shape of the curve, and it's inverted at the front end. So we know those overnight yields are higher than where the market would set them. And the Fed agrees, right? Policy is restrictive. Who's affected by overnight yields? It's small business, which you're funding with a bank line of credit or you're funding with credit cards. It's families who can't make ends meet, who are running a constant credit card balance. We've had restrictive policy now for 4 years.
Very restrictive.
And that restrictive policy is, in one sentence, the Federal Reserve trying to cure inflation on the backs of small business, 70% of job creation in normal times. Families living paycheck to paycheck. They're creating a lot of that economic disparity that you're talking about. Then you look at the job numbers, they're running a policy that's causing the unemployment rate to rise. We don't need policy to be that restrictive. I think they're doing the right thing cutting rates. Arguably, they should have started sooner, and I do understand the tariffs made that effectively impossible. But from here, they should probably be thinking about stepping it up, I would argue.
Mark, anything to add?
Yeah, I think to a certain extent that's what Chris Waller's almost defending, saying that yes, we need to dial back how restrictive our policy is and we need to let growth flourish a little bit because productivity is increasing, and we also need to support people who may be getting phased out of these lower level jobs by AI, by our restrictive policy. And a bit of anecdotal evidence of that, my Uber driver from the airport to the hotel, he used to run an Airbnb management business with his wife. They had 5 or 6 employees, things were going really well, they were making a lot of money, managing about 20 Airbnb properties around Nashville. And then one of his competitors either had somebody develop for him or developed himself an AI platform that managed all of his properties for him. And then what ended up happening was because the AI option was much cheaper, they didn't have to pay as many people, it was all done automatically, he was able to expand and take over more and more homes. And so the Uber driver that I had, he ended up losing his business because he lost it to a competitor who was purely using AI. So in order to make ends meet, him, his wife, his son, they all needed to start driving for Uber because they needed to make money and they needed to quickly change what they were doing to make ends meet. And he was even talking about how he fears the self-driving cars that are being introduced downtown, they're going to soon come for his business again. So he was saying that he needs to find something new now to do because AI is now taking his business and now his next job, and he's going to have to find something else to do.
Another shock, I'd say, that interacted with the labor market this year that has complicated our ability to understand policy or the economic trajectory is stricter immigration enforcement. I think this is one of the primary causes of the divergence of thought within the FOMC. The idea that labor force growth is certainly lower because of stricter immigration enforcement. So what is the so-called break-even job growth? If labor supply is growing less, then naturally labor demand or jobs added can also be lower and the economy is still in balance. The dubs within the FOMC, like Bowman and Waller, feel like job growth can still reach 75, 100,000 without the economy overheating. And then you have Chair Powell throw the idea out there during a press conference that maybe break-even job growth is 0. And I think some of the hawks have even said it could be negative. What do you guys think is the break-even job growth right now, or is it something that we just pick up on by looking at the unemployment rate or other measures of labor market tightness? And I don't want to spend too much time on this question because I do have a lot of other things we talk about, but I think it is important to factor into the analysis for the labor market in the next 12 months.
I think the neutral rate of job growth is kind of like the neutral rate for the Fed. And Chair Powell describes it as we know what it is when we get there. And he described it, walking through a dark room filled with furniture, you don't know that you're walking into something until you bump into it.
Mark's exactly right. This is not, as my friend JD likes to say, this is not rocket surgery. This is, if you see the unemployment rate rising like it is now, then I'll tell you, whatever the neutral rate of job growth is, it's faster than the 29,000 average we had the last 3 months. So while I appreciate the Dallas Fed has dug into this and the Chicago Fed, one of the things that complicates it is that the Census Bureau only measures the population, only estimates it once a year. So right now, we're in October, and we're using a population estimate in 2023 and 2024, drawing a linear line, assuming the same population growth in all of the labor statistics, and yet we know the border's been closed, so we know those numbers are garbage. By the same token, those estimates, which are somewhere between 0 and 50,000, they're probably a little too low. I would argue it's probably faster. But I would also argue, as Mark says, it almost doesn't matter from a policy standpoint.
Sophia, any thoughts?
Yeah, I would say it's probably a little faster than 50, but I think probably a little slower than 150.
Perfect. Yeah.
Slower than it was a couple of years ago,
Yeah.
but faster than zero.
Classic economist,
Right.
right on the one hand and on the other hand, and then we're always right.
But I do think that the different views there feed into the bifurcation we've seen within the FOMC. So there's a difference in opinion of how to read the current conditions, but also where neutral policy is. I think all of those differences aside, there's still enough agreement within the FOMC that rates should go a little bit lower. So we should see a rate cut later this month, probably one in December. Past that, I'm not sure. But there are still some Fed officials that have said publicly, if I see job growth at 20,000 a month, I'm actually not that concerned. Is it possible that this camp within the FOMC is so fixated on the idea of low, maybe even negative break-even job growth that the Fed is too late to cut and there is a risk of recession just from policy being restrictive for too long?
I'm going to take the no on that one. And here's why. If you listen to the 19 on the FOMC, there are, as Will said, there is a pretty significant group of people who are really dead set, very skeptical about continuing to cut rates much longer. But most of them are among the regional presidents. Two of the most hawkish vote this year. That's Alberto Mussolem and Jeff Schmidt. So they're falling off of the committee at the end of the year. They won't be voting next year. One of them is Beth Hammack, Cleveland. She does vote next year. So we'll have one more hawk coming on. But it ultimately is the 7 of the 12 that vote who are at the Fed in Washington, the governors, who tend to control the direction of policy because they tend to think alike. They're working with the same economics team, and they tend to be the core that drives policy. So when I add up who are the hawks, who are the doves, there just aren't enough of those really skeptical hawks on the committee this year or next.
Who are actual voters.
Exactly.
Yeah.
But that said, I do think there's a really good chance we could see the 2 rate cuts this year and then a pause. Like maybe even half of next year they don't do anything, because once they get the employment market, the labor market stabilized, once they feel like there's no significant risk of job losses, then the focus shifts back to inflation, and we have to see that trending back toward 2%. And it could take a little while, maybe several months into next year before the tariff effects fade enough to allow that to happen.
Yeah, I would add, I think there's definitely a bias for easing this year, and I think the government shutdown adds to that bias a little bit, right? We have a Fed that's heading into the meeting as blind data-wise as all of us are without government data, but I think that probably will encourage them to ease if they weren't already going to, because there's risks to the job market in the federal world as well. But I think, Chris makes a great point. So much of it comes down to who votes. But the other thing I think is a really important thing to remember as we move through always about the Fed, that it is a committee, right? And everyone does get to bring their opinion and what they're seeing in their districts and what they're seeing from their teams. And they do have a discussion. And Powell has even said recently they've been quite good and lively discussions. And I think in a time like now where there are, right, risks to both sides and there's no risk-free path, I think it's great that it is a committee and that there is discussion and that it doesn't have to be just, one point of view always, but the governors will probably lead the charge. And then I'll add, there could be some shifts in who's on the Board of Governors next year as well. And by could be, I mean will be.
Yes.
And that adds another piece of uncertainty.
Yeah, so I want to follow up on that, but Mark, do you have anything to add?
Sophia just jogged my memory that because the Fed doesn't currently have data, being the government is shut down, when they do start getting data whenever the government does reopen, the DOGE job cuts that went into place earlier this year, those workers who took that optional 8 or 9 month severance, whatever it was, that their layoff didn't technically start until September, they might start showing up in the unemployment numbers and the job cuts
Good
numbers.
point.
Right, probably in the October data.
In the October data when we start getting that data again.
I will say we should get inflation on Friday, CPI.
Oh, yeah.
Because the BLS called back a skeleton crew because
Right.
they have to put together the CPI to do Social Security adjustments. So We'll get some data on Friday. Very exciting stuff if you're an economist.
But to follow up on something you brought up earlier, how this is a committee and these individuals have these votes, we often talk about the Fed, usually with the shorthand that we're talking about the median, but there is a difference of opinion. And like I said before, even if there's enough agreement that we should cut rates in October, potentially, or likely even in December at this point, past that, are we going to see that difference in opinion get narrower or wider as things go on, especially when we have a new Fed chair next year who may not be able to build the same consensus as Jerome Powell has had? Are we going to see a lot more dissents next year? They used to be very infrequent during the Powell tenure, and then in the last year we have seen a couple big ones. So what does the consensus within the FOMC look like next year?
I would say, I think we used to say, Chris, and you, I feel like, taught me this from the get-go, right? When the Fed's getting ready to cut, you start to see the consensus in the dot plot, right? When you tend to have that really wide range, it used to be they're getting ready to cut or to raise rates. And it's fascinating to see now, they cut in September, and there was still a wide range as to what they should have done in September. We had a soft dissent in the dot plot, right?
Right.
Beth Hammack, who said, I don't think we should have even made this
That
decision.
was Beth Hammack, yeah.
And then you had, someone who was in favor of even bigger cuts at all the meetings. And so it's interesting to see that even while the Fed is making policy decisions right now in an active easing cycle, there's still a wide range. I think you'll probably continue to see that through half of next year as the Fed tries to see how have these rate cuts we've already put into play, if they do more this year, impact the data. And until we get clarity in sort of where things are going, I think you'll probably still see that range of opinions with a bias in one direction, but a wide range as to how much they should ease.
Yeah, I think in this case, there's two things at play, right? There is this transition. We're going to have more governors who are Trump appointees who are coming in. At least we'll have a Trump-appointed Fed chair by the middle of next year. So that's part of it. Anytime there's a change, and this was true when Bernanke came in, when Yellen came in, and initially when Powell came in, there's always a little bit of skepticism. It takes a little bit of time to build consensus. And even Powell, the master consensus builder, took time. In that sense, it's going to depend who gets the job. If Chris Waller gets the job, I think he can build consensus very quickly. If Kevin Warsh gets the job, I don't think he even cares to build consensus. He's been very vocal about that. That's number one. The other thing is, as Sophia pointed out, as you get closer to actually making a move, you tend to see the dots coming closer together. That is, the opinions within the Fed about where rates are going to be at the end of the year start to come together. But the closer you get to different people's concept of where neutral Fed funds is,
right,
then you start to see the dots disperse again. There are members of the Fed who think we're already within a quarter point or so of neutral Fed funds. There are others at the Fed who think it's 200 basis points from where we are now. And I don't think that's going to change very quickly. Yeah. So at the end of every easing cycle, there's growing disagreement because people have different concepts of where neutral is. And ultimately, those policy decisions have to be made on observing labor data, observing inflation data, and once it's confirmed, okay, inflation is still coming down and job growth is maybe a little weaker, then they can go.
We've only got a few minutes left, so I want to wrap up a question for all of you. The economy has felt like it's been in this delicate balance for actually a lot of the last few years, but particularly this year with all these federal policy shocks. Maybe the next job report is going to be the one that shows unambiguous labor market deterioration. Things are just going to fall apart. So with that backdrop, what is keeping you up at night? I know, Chris, your forecast is for stable economic growth and for a low recession probability, but what is something that you feel really poses the biggest risk to that and could cause a downturn?
Let's let Mark go first, because he didn't get to answer the last one. What keeps you up at night, Mark?
We talked a lot over the past year or so about the continuing jobless claims and how long people have been unemployed if and when they do lose a job. There was a survey that comes out from the New York Fed every single month. 2 months ago, it hit the lowest index on the record that they have. It goes back to 2014, of the number of people who thought they could find another job within the next 3 months if they lost their job today. It hit a record low, around 45%. So there's very little confidence out there in the labor market right now that if I lost my job tomorrow, that I could go out and find another one. And I think that we've talked about that for so long, and it's been an issue, and it's been why we think unemployment's pushing a little bit higher, why we think the Fed needs to cut. And I think that when people become structurally unemployed, that it eventually leads to a downturn. That is the thing that's been my primary concern for the past 6 months or so.
And that'll continue into next year.
And I think that'll continue into next year, and we've already seen the weakness in the jobs gained and the unemployment rate starting to rise a little bit, so that's my primary concern.
Yep.
I'll start off by saying I sleep pretty well and value my sleep, so good work-life balance, I recommend it to everybody. But the one thing that is top of mind and something that I worry about both in terms of sort of the sustainability of growth and also what 2026 will look like is that widening wealth gap. And particularly, I think the way the middle is feeling more like the lower income, right? And that things like housing are still very, very expensive and sort of all of those basic needs. And I worry that that makes growth unsustainable, right? That some of this very fast growth we have might be on slightly shaky footing. So that to me is something that I think we've seen sort of throughout the last couple of years that I'm still worried about as we go forward.
Chris?
I've been a bond economist for 40 years. It's got to be the debt and deficit that keeps me up at night. I can't stand the fact that when you think about the U.S. government, right, the three branches, each branch is delegated a different area of authority. Those are the checks and balances. And the most important responsibility of Congress is the power of the purse, deciding what to spend and how to collect revenue to pay for it. And, when I look at these guys and gals, I'm sorry, but it seems like it's their lowest priority sometimes. They're just so involved in trying to police society, the way we behave, or trying to control the way business is conducted, and less the fundamental. You talk about the haves and have-nots, and it's absolutely true. The wealth gap in the United States, the income gap is wider than it's been at least in many, many decades. What happens to our ability to take care of people when we have that inevitable recession and the deficit blows out again because revenues collapse? That's what keeps me up at night, that we're running these $2 trillion deficits after 4 years of really significant, decent economic growth.
Unfortunately, that's all the time that we have today, but thanks everyone for coming to the conference. Thanks for participating in this lively discussion. And thanks to my panelists, Chris Low, Mark Streiber, Sophia Kearney-Lederman. Hope to see you at the next seminar.
Thank you very much.
Thank you.
That was FHN Financial's Chief Economist Chris Low, Senior Economist Sophia Kearney-Lederman, and Economic Analyst Mark Streiber. I think that panel discussion really brings to light how often the economy faces big shocks that could move it off its current trajectory. The economy survived the initial tariff shock from earlier this year, but lagged impacts still pose a risk for price pressures, the budget, and industrial output. AI could eventually become a truly transformational technology, but the pace of adoption and labor market displacement is highly uncertain. The composition of the FOMC, too, could change investors' current expectations for the path of monetary policy next year and onward. The Supreme Court is set to hear oral arguments next Wednesday on the president's unilateral use of emergency powers to implement many of this year's new tariff policies. The court is not expected to hand down a ruling until next year. The government shutdown won't stop several private sector data releases from being published next week. The October ISMs will be released Monday and Wednesday. October vehicle sales on Monday will give the first major data point on Q4 consumer spending. And ADP's monthly private sector employment estimate will be watched on Wednesday, given the absence of BLS payrolls data. Government data scheduled for publication over the next 2 weeks will almost certainly be postponed because of the shutdown. This list includes weekly jobless claims, the September JOLTS, and the jobs report, CPI, retail sales, and PPI for October. The bond market will be closed on Tuesday, November 11th, in observance of Veterans Day. Also next week, Treasury will announce its latest financing and refunding estimates. Analysts widely expect that coupon auction sizes will remain unchanged for the foreseeable future, suggesting a continually rising share of bills being used to finance outstanding Treasury debt. Fed speak continues as well now that the pre-meeting communications blackout is over. There are a few officials scheduled to speak already, but the end of the government shutdown or continuation of major data releases should inspire more to pop up. That's all for today's episode. Thanks again for listening. I'm Will Compernell, macro strategist with FHN Financial. This episode was edited by Bill Stanfield. Don't forget to like and subscribe to Simply Put wherever you get your podcasts. Email simplyput@fhnfinancial.com with any questions or comments. This podcast is presented for informational purposes only and is not intended as an offer or solicitation with respect to the purchase or sale of any security. Views expressed herein accurately reflect the speaker's personal views about the data, news, trends, events, etc. discussed herein or any subject securities or issuers. No part of their compensation was, is, or will be, directly or indirectly, related to any specific recommendations or views expressed. FHN Financial, through First Horizon Bank or its affiliates, offers investment products and services. Investment products are not FDIC insured, have no bank guarantee, and may lose value.